Good morning. We will pay attention to the cash flow today. And in this recording, we will look at the notes and where do you get the information to complete the notes. Our first note is always to determine what is the difference between income and expenses, so how much money came into the business and how much money went out of the business, and current assets and current liabilities. So the income and expenses information will be given to you in the income statement. That means we have to look at the net income or profit before tax. Very important, the amount that you start off with will be before tax because income tax will be done as a separate entry on the cash flow statement. Sometimes they give you the net income after tax. That means that you have to add the tax to it to determine what is the amount before tax. Then this profit that we made was made after we took all the expenses into account. Interest was therefore deducted to calculate the profit, but interest must be shown separately on the cash flow statement, therefore we will add it back. Depreciation is not money flowing out of the business, so therefore we will also add it back to determine what was the inflow as a result of income and expenses. We will start with this profit before tax, then the depreciation is not given to us, but we calculated the depreciation in recording 1. So we will use that figure. The interest was given in the income statement as 26,000, and if we add up these three figures, it gives me the total inflow of money as a result of income and deducted expenses. Now we will look at the change in working capital. That consists of your current assets and current liabilities. They are recorded in the balance sheet, so we will go to the balance sheet to determine what is the figures. Inventory, the previous year was 144,600. This year it's 141,440. That's indicating that the inventory decreased from the previous year to the current year. If inventory decreases, what happened? We sold some of the goods, so that means here is an inflow of money in the current year. If we look at trade debtors and we look at trade creditors, we will see that there is a note for them. So it means we can't just use the figures in the trial balance or balance sheet. We have to go to the note. Trade debtors consist of the debtors, accrued income. If it's not in a connection with interest, then it will be added. SARS income tax is shown separately on the cash flow statement, so we will not take the SARS into account. So we will take the accrued income and the debtors into account and work out what is the difference between this. So 2017 is 95,500, 2016 is 81,600. 2016 is lower than 2017, so the debtors owe us more money. So what happened? We financed them that they can owe more money, so that caused an outflow of money. In creditors, there's trade creditors. SARS income tax is shown separately when we calculate what is the outflow as a result of income tax paid. Shareholders for dividends is shown separately, so here we will just work out what is the difference between the previous and the current year for creditors. The creditors decrease, so we owe less money because we paid money to them during the year, so there was an outflow of money. If we look at the information, we can see that the dividends paid out in the current year is not given to us, and they also didn't give us the amount that was declared during the year. If the income tax or the profit or the dividends is not given to you, you have to open a retained income account and determine what is the unknown figure by balancing the account. Therefore, we will go to the retained income and we will use the figure 155,000 as the opening balance and 259,140 as a closing balance. Then the other entries that go to the retained income account is your profit after tax and your dividends. I will start with my balances that's given to me. I calculated that the profit after tax is the amount that they've given to us less the tax of 90, and that means the retained income increase with the money that was available to the shareholders. And by balancing, I can determine what was the total amount that was declared as dividends in the current year. Now, if I've got this amount, it means I can record it in the shareholders for dividends account. In the shareholders, our opening balance is 35. The closing balance is 40 according to the balance sheet. The amount that we calculated now for dividends in the retained income account was 26,060. So we debited dividends, the expense account, and we credited shareholders to indicate that is the amount that's owed to shareholders. And by balancing, we can work out what was the total amount of outflow in the business as a result of the dividends that was declared. When we look at income tax, we will also record the opening and closing balance and the income tax for the year to determine what is the amount paid out. Now, if you look at this income tax, in the majority of cases, the income tax opening and closing balance will be under creditors. In this example, the opening balance of income tax was on the debit side. So it means that we must start the beginning of the year with a debit balance of 7,000, indicating that SARS owes money to the business because too much provisional tax was paid in the previous year. Then we will debit the income tax account with the actual tax for the year, credit SARS to show that that is the amount that's owing to them. If we look at the closing balance, we see that it is a credit balance. So it means the balance was brought down on the credit side. Before it can be brought down, you first have to carry it over on the debit side. So the difference between the debit and the credit side is my balancing figure indicating the outflow of money as a result of income tax paid. You can do a ledger account to determine the amount, or you can do a note for the tax and the dividends. Then there is also a note for non-current assets purchase. I just want to explain what you have to take into account here, and remember that we sold equipment. So for equipment, you can't subtract the opening and closing balance cost price because there was a movement of assets sold. So the one that's sold, you must always do a T account. If there was nothing sold, you can just subtract the opening balance and closing balance from each other to determine how much money went out of the business for purchases of fixed assets. If we look at buildings, the opening balance was 240,000. The closing balance is 399,000. So if we subtract it from each other, we see what is the amount that was purchased and was used this year for buying buildings. Vehicles, the opening balance is 329,900. The closing balance is 479. If I subtract that from each other, I will also determine the amount of outflow. In equipment, this is the red dot area. So that means you must look out for this one and realize if we sold equipment, it means that we can't just subtract these two from each other. We must do the T account so that we can determine what is the proceeds from the assets sold and what is the amount that we paid for the new assets purchased.